The Consumer Price Index CPI data for March 2017 indicates that inflationary pressures eased slightly. Annual headline and core inflation declined to 6.4% and 4.8% respectively in March 2017 from 6.7% and 5.7% in February 2017. That is a decline in annual headline inflation from 6.4% to 6.4% from 6.7%, and decline in core inflation from 5.7% 4.8% in February 2017. The stability of the shilling exchange rate, as well as subdued domestic demand, have contributed to the dampening of inflationary pressures. Annual food crop inflation has, however, continued to rise, increasing to 20.7% in March 2017 from 18.8% in February 2017 as a result of the drought which affected food production in many parts of the country. The latest quarterly gross domestic product data released by the Uganda Bureau of Statistics at the end of March 2017 indicates that the economy grew by 0.8% quarter on quarter in the quarter to December 2016, compared to a contraction of 0.1% in the quarter to September 2016. A growth of 0.8% quarter to quarter 2016, compared to a contraction of 1% in the quarter to September 2016. Given the weak economic performance in the first two quarters of the current financial year, the projected growth of GDP of 4.5% in 2016-2017 is unlikely to be achieved. The anticipated lower growth in fiscal year 2016-2017 is largely driven by supply-side factors, notably the impact of adverse weather conditions on agricultural output. The agricultural sector contracted on average by about 2% quarter on quarter for 4 consecutive quarters in the second quarter of 2016-2017. Output should revert to trend once the supply shock has dissipated. On the external side, the current account has improved because of stronger export proceeds and higher workers' remittances, coupled with weak import growth. The Bank of Uganda's forecasts indicate that the near-term inflation outlook has improved since the last Monetary Policy Committee meeting here in February, mainly due to a relatively stable exchange rate of the shilling. This has offset some of the negative price impact of the supply side shock. The revised forecasts indicate that core inflation will be around 5% in 12 months' time, which is exactly in line with our medium-term forecast. Given that core inflation is forecast to remain around the medium-term target of 5%, and in line with efforts to support private sector credit and economic growth momentum, the Bank of Uganda believes that there is scope to continue easing monetary policy. Accordingly, the Bank of Uganda will reduce the central bank rate, CBR, by 0.5 percentage points to 11%. The band on the credit on the CBR will be maintained at plus or minus 3 percentage points, and the margin on the rediscount rate will be maintained at 4 percentage points on the CBR. Consequently, the rediscount rate and the bank rate have been reduced 15% and 16% respectively. This is the monetary policy statement for April 2017.